But in this case, how would you tactically position portfolios for what could be an extended period of weakness?
Yeah, that's a great question, Kelly. We're in a shock and awe. We had the shock, if I can stay with the wartime analogy that's been used, and now we're in the awe phase. And what we see in this type of scenario, the three things. Like I used to be a fighter pilot, and if you get an emergency, number one thing is keep flying the plane. So you need to keep flying the plane of your portfolios. So number one, make sure your allocation's right, make sure you're well diversified, and then just keep managing the portfolio and the names that you would have in the portfolio. And I would take two steps. First step is things that are going to hold up reasonably well within the current environment. And that's, things like healthcare, some technology, some utilities and those sorts. And then things that will, also work on the other side of it so that you can stay invested throughout this period of time. There's great opportunities when the markets are down like this to do some buying, and when they're way up to do some selling. But stay with the plane, keep flying it.
Yeah, I was going to say, if from anyone else, it would just be, a trite analogy. When you're a fighter pilot, you get to use those terms, Barry. Let me turn, Robert, to you, and on the fixed income side, ask kind of similarly. I mean, it's no more safe in fixed income right now because you either have extremely high valuations or a higher default risk than normal. So what's your advice?
Yeah, thanks, Kelly. I mean, the way we're looking at this is the fundamental problem here is an economic problem, which is the virus and the sudden stop that we have in the U.S. economy, which is really unprecedented. But on top of that, we need to be very careful about the financial system and the financial credit facilitation across the economy, because if we don't want to have a financial crisis on top of this economic crisis, we need to make sure the policymakers are really putting through that credit through the system. I mean, I'm sure most viewers are aware of the amount of issuance that we've been getting in the credit markets. In March, we got $259 billion of investment-grade issuance. We've had tremendous outflows out of fixed income funds. In March, again, about $260 billion out of fixed income funds. All that is offset against the fact that the Fed has been doing QE. So what we need to do, what the policymakers need to do, is ensure that they facilitate the credit in the economy to make sure that we can go through this bottoming process.
Yeah, so explain, Robert, a little bit more about what you mean by that. Are these using conventional tools or some of their new toolbox?
Well, we're looking forward to their investment-grade purchasing program really getting going. But we think they need to look in two different areas. One, they have very highly constrained the financial system now. So the banking system has a large amount of regulatory structure around it, which really keeps the banking system from flexing its balance sheet in response to credit demands like we're getting now. So one approach here would be to ease up on some of these regulatory burdens on the banking system so the banks could actually move to provide some of that credit to the system. Another approach would be for the Fed or the Treasury to be much more aggressive in buying other assets, which could also be done. We've seen that they're said they'll buy investment-grade bonds. That's going to start. And as a result, the investment-grade market has seen more support. But there are areas, including areas of the mortgage market and the structured market, that's very important to the economy, where we haven't gotten support from the Fed so far.
Interesting. So you're saying they either need to ease up bank regulations so that the banks themselves do more lending, or have the Fed itself kind of come in with that credit support. Barry, if you could just reflect for a second. I mean, there are so many similarities, unfortunately, between now and what happened in 08-09, even though that time it felt like there were imbalances in the economy that needed to be addressed. And this time around, I'm not so sure. Does it matter, I guess is what I'm saying, in terms of what brought us here and as it relates to how we get out of this or how you should be investing?
It is, I think, quite a bit different than 08, which was a financial crisis that just kind of consumed itself in the end. The Federal Reserve has learned from that. They have almost unlimited QE out there, and they're supporting the credit markets and the like. So I think we're not going to have that problem, and the banks aren't going to face the fact that they don't have any reserves. So that's a different piece than what we have. This is a real recession that could be incredibly deep. It might not be long, but it will be incredibly deep. And the one truth that I've always found is that things always go further than you think they should. And that will happen both to the economy, to the stock market, to the bond market, and of course to the entire United States. So some similarities. We've gotten a lot of the risk out of the market that you would normally see, but we have this whole outside factor that is totally different than what we saw in 08.
Do both of you think we need, although we've already seen programs which could equal 40% of GDP, do we need to see more? And do we worry about the sort of side effects and consequences of that, especially on the debt and deficit, or no? I mean, very quick answer, Robert, I'll give you the last word.
Well, I think what we're talking about here is really extending credit rather than outright fiscal payments. We've had this fiscal package. It's pretty substantial. I think we need to see how that washes through the economy. But we are very concerned about making sure the credit channels stay open and facilitate credit extension to finance all of this sudden stop that we have in the economy.
All right. And Barry?
I think we're starting to see it spread out. A local church just got $200,000 on the small business side. So there is money actually going out, and hopefully it will be a support for right now. And I think we just need to see how that works first.
All right. Fair enough. Thank you both today.